What's up guys, and welcome to Wall Street Millennial. On this channel, we cover everything stocks and investing, and today we're covering the epic implosion of Bill Hwang's Tiger Asia hedge fund. It was first reported late last week that the multi-billion-dollar family office was being forcibly liquidated by its brokers after sustaining huge losses, causing multiple stocks to see large falls in their prices. Before we get into the video, keep in mind that we are not financial advisors and always consult a professional before making any investment decision. In morning trading on Monday, March 29th, most of the stocks reportedly on the chopping block for Archegos' prime brokers were trading lower. After surging at the open, for example, the Chinese equivalent of Google, Baidu, was down about 5% to $200 a share. GSX, another major holding of Archegos Capital, was down 10% after having been down as much as 15% earlier in the morning. Similar price action gripped VipShop and iQIYI. However, one Chinese tech stock that bucked the trend was RLX Technology. That stock was up 15% midday. The American media companies that were hit by the liquidation were primarily Discovery and Viacom-CBS. These stocks also opened strong, but were down midday on Monday. Discovery was down about 3%, while Viacom-CBS was down about 7%. According to a post on the Chinese trading app Tiger Trading, someone who claims to have knowledge of the situation says that the selling pressure might not be over yet. According to this person, Bill Hwang actually was levered up to 5 or 6 times. Based on the losses reportedly incurred and the percentage moves of his holdings, he estimates that the total value of Tiger Asia's assets was more like $80 billion US. If true, that is significantly higher than previously reported by American news outlets. This would mean that there may be more assets to liquidate and the selling pressure may not be over yet. Apparently, Archegos was an extremely discreet hedge fund even by hedge fund standards, and very little is known about how big their positions were. Trying to figure out if the selling pressure from the prime brokers is over yet is even harder because a lot of the blocks that Goldman Sachs and Morgan Stanley were selling were over non-public sales to clients. Also, Archegos reportedly used swap contracts to obtain huge amounts of leverage on their positions without having to report it to regulators. Because of these factors, it is very hard to know if the selling pressure is over yet. It was also recently reported that the SEC has been monitoring the Archegos situation since last week. The SEC has not published any press releases on the issue as of March 29th, but this confirms that the regulators are in fact concerned with the fallout of Tiger Asia's liquidation. Archegos gained access to so much leverage by entering into swap positions with various investment banks as their counterparties. When Archegos blew up, the ripples were felt all across Wall Street.
And if I could just back up for a minute and try to explain to our viewers, what are we talking about? Well, it does appear that Archegos, this family office / hedge fund, whatever you want to actually term it, had swap agreements across Wall Street with all sorts of different prime brokers, whether it's Goldman Sachs, whether it's Morgan Stanley, whether it's Credit Suisse, which, as Jim just mentioned, may have significant losses, whether it's Nomura, and on and on. And none of them seem to have an understanding of exactly how large the positions were at the other firms. And a swap basically gives a derivative. The stock is held in the street name, but the derivative that's tied to it gives the economic value to the owner there. And so Archegos had, well, now we know perhaps as much as 15% or more ownership economically of Discovery and Viacom. Those numbers are just astronomical, and apparently buying them all through, the main reason they may have moved up to the levels that they did, and then having been thrown as Viacom proceeded to do that offering early last week at $85 a share and the stock suffering, that may have started this cascade where the selling began. And by the way, it's not just owning it on swap where there's no transparency and nobody really knows, including the companies, who their true owners are. It's also the leverage being provided by the prime brokers, Jim. 5, maybe as much as 7 times. And that's where we are right now. And this may not be over. I've heard from numerous people this morning that Wells Fargo may be shopping a large block of Viacom as well. And so we'll see. They did the $45 million last night at, what was it, 47, I think it was. But there may be more downside here. We'll have to wait and see. But this has been a fascinating story, Jim, both from the lack of transparency, the leverage that was being used, and the size. Nobody knows exactly what this guy who runs Archegos was thinking. It seems almost insane, his behavior.
Bill Hwang's losses were so great that it wiped out more than 100% of his equity, and his brokers are left holding the bag. Japanese investment bank Nomura says that they were expecting to incur a $2 billion loss as they were forced to liquidate Hwang's holdings at a fire sale price. This caused Nomura's stock to fall more than 13%. Credit Suisse also declined 13%, wiping more than $3 billion off the Swiss bank's market cap, as they also say they expect material losses from the Archegos fiasco. Goldman Sachs and Morgan Stanley also incurred losses, but their stocks are only down slightly. Their market caps are much bigger than Nomura and Credit Suisse, so the losses have to be a much smaller impact to their stock price. Investors are currently trying to wrap their heads around whether this saga will have broader implications for the financial system. Hedge funds have been known to cause financial disasters in the past. For example, in 1998, quantitative hedge fund long-term capital management blew up. The Federal Reserve feared that long-term capital management's failure could cause their financial counterparties to go bankrupt and cause massive disruptions to the financial system. So they organized a $3.6 billion bailout funded by a consortium of investment banks. Long-term capital management strategy was to make arbitrage profits from small discrepancies in bond prices. The profit from each of these trades was very small, so the only way they could make serious returns was to employ massive amounts of leverage. At the peak, they had $4.7 billion of equity, but had off-balance sheet derivatives positions with notional values of $1.25 trillion, giving them a leverage ratio of 250 to 1. They convinced their brokers to offer them so much leverage by saying that their strategy was risk-free. In normal circumstances, this was true. However, in 1998, Russia defaulted on its sovereign debt, upending the normal trading of the global bond market. This caused long-term capital management's portfolio to explode and almost take the global financial system down with it. In the case of Archegos, they were only leveraged 5 to 6 times. While this is enough to cause disruptions in the market, a financial collapse is highly unlikely. And it turns out that there may actually be a second hedge fund involved in the market carnage. On March 18th, the institutional investor publication reported that Tung Yue Partners, a $10 billion hedge fund, also incurred heavy losses on its position in GSX. Tung Yue is run by Tao Li, who used to work for Bill Huang at Tiger Asia from 2004 to 2011, before leaving to start his own hedge fund. As of December 31, 2020, Tung Yue had more than $10 billion of regulatory assets, which includes leverage. They had a great year in 2020, with their assets more than doubling from $4 billion in 2019. They were also off to a great start in 2021 and were up 40% through February as their highly leveraged bets were paying off. One of these bets was GSX, and as the stock plummeted more than 60% over the past couple weeks, they lost more than 50% of their portfolio value and their year-to-date return is now in the negative teens. And some people don't think it's a coincidence that both Archegos and Tung Yue were both short GSX. On March 27th, short-selling firm Muddy Waters tweeted that between these two hedge funds, as well as Tiger Global Management, the three hedge funds own 75% of GSX's float. Muddy Waters thinks that GSX is a fraud and there is no fundamental bull case to warrant owning the stock. Falling just shy of outright saying it, he suggests that these three hedge funds were conspiring to push the stock price up to induce a short squeeze. But what is the relationship between these three hedge funds, and is it really possible that they were working together? It turns out that they can all trace their roots back to Tiger Management, one of the first major hedge funds founded in 1980 by the legendary investor Julian Robertson. At its peak, Tiger Management had $36 billion of AUM and provided its investors with unmatched returns up throughout the 80s and 90s. However, in 2000, they made a concentrated long position in US Airways, which ended up going bankrupt, tanking the Tiger's portfolio and forcing Robertson to wind down the fund. After Tiger Management dissolved, many former analysts and portfolio managers started their own hedge funds. Furthermore, Julian Robertson invested his own money into promising young hedge fund managers as seed capital. These hedge funds are colloquially referred to as Tiger Cubs and are estimated to manage more than $230 billion of assets today. All three of these hedge funds involved in GSX are so-called Tiger Cubs, and they could potentially share information and discuss investing strategies with each other. While there is no direct evidence of any collaboration, as Muddy Waters says, you're free to draw your own conclusions. Alright guys, that wraps it up for this video. If you like this content, make sure to smash that like button and subscribe for future videos. Also, check out our second channel, WSM Research, where we post DD on high-growth tech stocks. As always, thank you so much for watching, and we'll see you in the next video. Wall Street Millennial, signing out.